So usually, when we look at a company's financial report, there's this expectation of a steady, predictable journey, especially for a legacy tech giant.
Oh yeah, absolutely. It's the traditional life cycle of a mature mega cap utility.
Right. It's typically like watching traffic on a well-paved interstate highway. You check the speed limit, you monitor the volume of cars, and you just collect your predictable tolls.
Because the infrastructure is already built. The capital expenditures have stabilized.
Exactly. You know exactly where the road is going. It's this comforting rhythm, right? You hit your quarterly targets, you pay your dividends, and you stay in your lane.
Yeah, the business basically just transitions into a pure cash flow optimization exercise. The element of surprise is, well, it's largely engineered out of the equation entirely.
But then you step into the world of big tech earnings right now, specifically this latest drop from Microsoft.
Yeah, that was a shock to the system.
It really was. Suddenly, we aren't looking at traffic on a highway anymore. We're watching a company completely tear up the asphalt, buy the surrounding land, and build this massive continent-spanning high-speed rail network from scratch.
All while simultaneously still collecting tolls on the old road, which is the crazy part.
Right. Welcome to the deep dive. Today, we're opening up the Microsoft fiscal Q3 2026 earnings call. We've got the official transcript featuring CEO Satya Nadella and CFO Amy Hood from April 29th, 2026.
And this call, the sheer scale of the numbers presented in this transcript requires a complete reevaluation of how we understand software economics.
Totally. Our mission today is to translate the Wall Street jargon, unpack the underlying mechanics of these numbers, and extract the actionable insights for you, the retail investor. Because reading this transcript, it's honestly like looking at the telemetry of a rocket mid-launch.
That's a great way to put it.
It's moving incredibly fast, it's burning an insane amount of fuel, but it is undeniably reaching orbit.
Yeah, we're looking at an established company attempting a pivot so resource-intensive that it breaks conventional financial modeling.
I've looked at a lot of mature tech companies, but seeing a baseline of this size accelerate the way it is, the physics of that just shouldn't work.
It really shouldn't. It defies gravity.
So by the end of this deep dive, you will understand exactly what drove this massive quarter. We're going to explore where Microsoft is headed with this agentic AI shift that's dominating the enterprise space.
Which is a huge structural change.
Massive. And we'll dissect that staggering capital expenditure bill. Plus, we'll analyze the structural brilliance of the new OpenAI deal. Most importantly, we'll determine whether these results scream buy, sell, or hold for your portfolio.
Well, I think we should start with the foundation. The narrative from management is one thing, but the raw data, that sets the parameters of reality.
Yeah, numbers don't lie.
Exactly.
Yeah.
We need to look at the top and bottom lines before we try to figure out the underlying causality.
Okay, let's get into the top line revenue. Microsoft reported a massive $82.9 billion for the quarter.
Just an incredible number.
Right. That represents an 18% increase year over year, or 15% in constant currency.
To really contextualize $82.9 billion in a single 3-month period, that means Microsoft is generating roughly $920 million a day in revenue.
Wait, almost $1 billion a day?
Yeah, pretty much $1 billion every single day. And the concept we really need to address here is the law of large numbers.
Right, because usually growth slows down when you get that big.
Exactly. In finance, the larger a baseline revenue figure becomes, the more difficult it is to maintain high percentage growth rates.
It's like trying to double the speed of a bicycle versus doubling the speed of a freight train.
Yes. To grow an $82.9 billion quarterly base by 18%, it defies the traditional gravity of enterprise software entirely.
It's unprecedented.
It indicates that they aren't just taking market share from competitors. They are fundamentally expanding the total addressable market.
And just for anyone wondering why that constant currency metric is relevant, because you hear that a lot on earnings calls.
Oh yeah, it's a crucial detail.
Right. So when you operate globally like Microsoft does, a strong US dollar makes your international sales look a little smaller when you convert them back to dollars.
Exactly. It's basically an accounting illusion caused by exchange rates.
So that 15% constant currency figure, that tells us the underlying organic demand is surging regardless of foreign exchange headwinds.
And this revenue flows directly down to the bottom line too.
It sure does. Earnings per share came in at $4.27, which represents a 21% jump year over year.
Yeah, both of those metrics absolutely crushed Wall Street's expectations. But, the real engine driving this growth, the segment we really need to isolate.
The cloud and AI, right?
Yes, exactly. If you want to understand Microsoft's valuation today, you have to look at the Microsoft Cloud segment.
Because that's where the real action is.
It is. That division alone reached $54.5 billion in revenue, growing at 29%.
29% on 54 billion. That's wild.
And within that broader cloud umbrella, Azure, which is their flagship cloud computing platform, grew by a staggering 40%.
40% growth on Azure. I honestly had to read that line in the transcript twice when I saw it.
I think a lot of analysts did a double take on that one.
And Amy Hood specifically noted that this growth was driven by both AI and non-AI services.
Right, which is an important distinction.
Yeah, it's not just a pure AI play. The core cloud business is surging right alongside it. Why is the non-AI cloud growing so fast right now? I mean, shouldn't everyone just be focused on AI?
Well, it comes down to this concept of data gravity.
Data gravity. Okay, explain that.
So to effectively use artificial intelligence, an enterprise first has to centralize, clean, and structure its proprietary data.
Oh, because the AI needs something to actually analyze.
Exactly. You cannot run an advanced AI model on fragmented data sitting in local spreadsheets across, 1,000 employee laptops.
That sounds like a nightmare for any IT department.
It is. So
Yeah.
companies are migrating their legacy, non-AI workloads into Azure at a record pace simply to prepare their infrastructure for the AI tools they eventually plan to deploy.
I get it. The AI hype is basically acting as a massive catalyst for basic cloud migration.
That's it exactly. The AI is the bait, but the basic cloud storage is the hook.
Wow, that makes perfect sense. They have to move their house into the cloud before they can buy the smart AI furniture.
Great analogy, yeah.
Which brings us to the crown jewel data point from this call. The AI business annual recurring revenue, or AR.
This is the number everyone was waiting for.
It surpassed $37 billion, and it grew an astonishing 123% year over year.
And this specific metric completely changes the conversation around artificial intelligence in the enterprise space.
How so?
Well, for the past 3 years, the market has been saturated with just AI potential. It's characterized by pilot programs, speculative hype, and theoretical productivity gains.
Right, lots of cool demos, but no real proof that companies would pay for it forever.
Exactly. Institutional investors have been growing impatient. They've been asking when these multi-billion-dollar research investments would actually yield sticky cash flow.
The classic show me the money moment.
Yes, and an annual recurring revenue of $37 billion is the definitive answer to that demand.
Because it's recurring. It's not just a one-off sale.
Right. We really need to distinguish ARR from one-time consulting fees or hardware sales. ARR represents locked-in, subscription-based dollars.
So they're signing contracts.
Yeah, it means enterprise CIOs have audited their initial pilot programs, realized the productivity gains are actually real, and decided that AI is now a fundamental recurring line item in their operating budgets.
They're committed. They aren't going back.
No, they aren't. Sustaining a 123% growth rate on a $37 billion base proves we have fully transitioned from the experimental phase to deployment at scale.
Okay, but this deployment at scale comes at a severe cost. This is where I want to push back on the unbridled optimism a bit and look at the margin profile.
Fair enough. Let's look at the costs.
Because we saw the gross margin percentage dip slightly to 68% year over year.
Right, a slight compression there.
To translate the mechanics of this for you guys listening, a lower gross margin means Microsoft is retaining slightly less profit on each dollar of revenue right now.
Because the cost of delivering that revenue has increased.
Exactly. They are spending heavily to build out the AI infrastructure. They're buying the servers, the GPUs, and paying for the massive amounts of power required to run them.
It's not cheap to run these models.
It's incredibly expensive. So my question is, are these AI revenue numbers just a temporary sugar high from early adopter enterprises who just want to play with the new technology?
You're wondering if it's a sustainable baseline.
Right. Because if it is just a sugar high, that margin compression is going to become a serious liability really fast.
Well, the margin dip is actually a classic, predictable characteristic of a platform shift.
You think so?
Yeah, if you look at the historical precedent from a decade ago, when Microsoft and Amazon were transitioning the world from on-premise servers to the cloud, we saw the exact same dynamic play out.
Oh, right. Building the original cloud data centers cost a fortune.
Exactly. Initially, building the physical data centers requires massive capital outlay, and the depreciation of those physical assets weighs heavily on your gross margins.
Because you're paying for the hardware up front, but you're only recognizing the revenue from the software sold on top of it over several years.
Precisely. But once that physical infrastructure is in place and operating at scale, The software services layered on top of it possess incredibly high margins.
Basically printing money at that point.
Yeah, and Amy Hood explicitly addressed this on the call. She noted that while company gross margins dipped to 68%, they are aggressively offsetting these infrastructure costs with ongoing efficiency gains within Azure and M365.
Oh, I remember that. Satya Nadella mentioned they delivered a 40% improvement in inference throughput just from software and hardware optimization.
Which is huge for their bottom line.
So they're actively learning how to run these massive AI models cheaper and faster, squeezing more computational juice out of the same exact silicon.
Right. And regarding your concern about sugar high, the underlying usage metrics suggest this revenue is highly durable.
Why do you say that?
Because enterprises aren't just buying access to a chatbot and letting it sit idle. They are deeply integrating it into their core workflows.
Okay, so it's becoming part of how they do business every day.
Exactly. To understand why this revenue is so sticky, we have to look at the structural change in how the technology is actually being used.
Okay, well, that brings us perfectly to the core strategy driving these numbers. We need to explore how Microsoft actually generated that $37 billion in ARR and what it physically cost them to do it.
This is the really fascinating part of the transcript.
It is, because throughout the transcript, Satya Nadella repeatedly used a very specific phrase. He kept talking about a shift to agentic computing or agentic systems.
Yeah, I'd argue it's arguably the most important conceptual shift in the entire earnings call.
Let's break down the mechanics of agentic computing for the listeners.
Sure.
Up until this point, the public's interaction with AI has been primarily synchronous, right?
Very back and forth.
Yeah, you type a prompt into a chatbot, you wait a few seconds, and it generates a response. It is a direct conversation that requires a human sitting at the keyboard actively driving the interaction.
You have to be present to make it work.
Right. But agentic computing represents the transition to asynchronous agents. Think of an agent not as a chatbot, but as an autonomous digital employee that operates in the background.
The distinction lies in agency and temporal independence.
What do you mean by temporal independence?
Well, instead of asking a discrete question and waiting for an answer in real time, you're delegating a complex, multi-step objective that it works on over time.
Exactly. You basically tell the agent, hey, monitor all the inbound sales emails that arrive overnight, cross-reference the request with our current supply chain inventory, draft personalized responses based on the availability of the products, and stage those drafts in my outbox for review by 8:00 a.m.
And then you go to sleep.
Right. The agent executes that entire sequence asynchronously while you are asleep.
Or, in a software development environment, an agent might be tasked with reviewing an entire legacy code base, identifying security vulnerabilities, and automatically writing and testing the necessary patches over the weekend.
Wow, just completely on its own.
Yeah, it operates with continuous agency, doesn't need you to hold its hand.
That is wild. And the adoption metrics for this asynchronous capability are unprecedented. Nadella provided concrete data on Microsoft 365 Copilot. They have crossed 20 million paid seats.
20 million is a massive milestone.
It is. But the velocity is what really matters here. Seat additions were up 250% year over year. That is the fastest growth rate they have seen since the product launched.
And he highlighted specific enterprise deployments too, which I thought was interesting.
Oh yeah, the big corporate names.
Right, like Accenture. They now have over 740,000 seats.
740,000. That's an entire global workforce equipped with an AI assistant.
Basically, yeah.
Yeah.
And Bayer, Johnson & Johnson, Mercedes, Roche, they are all committing to 90,000 or more seats.
That's a huge commitment.
On the developer side, GitHub Copilot enterprise subscribers have nearly tripled. Furthermore, nearly 90% of the Fortune 500 now have active agents built with Microsoft's low-code tools.
It's literally an industrial revolution occurring within knowledge work.
It really is. But, the technological shift toward agents is profound. But the business model shift accompanying it is what fundamentally alters how we should model Microsoft's future revenue.
Oh, this is the really good stuff.
CFO Amy Hood detailed a transition that investors absolutely must understand. Microsoft is moving from a traditional per-seat subscription model to a seats plus consumption model.
The seats plus consumption model. I love the analogy of a cell phone plan to explain this concept to people.
It's the perfect way to look at it.
Right, so think about the early days of mobile phones. You paid a base subscription fee just to have the line connected to the network, that is, the seat. But if you use massive amounts of data, you pay extra for the consumption.
The overage charges.
Yes. Microsoft is applying this exact logic to AI. You pay the base subscription for the M365 license. But if your autonomous AI agents process massive amounts of computational tokens by running complex asynchronous background tasks all day long,
You pay extra for that consumption.
you sure do. They have locked the enterprise into the ecosystem with the basic seat, and now they are monetizing how intensely the enterprise relies on the AI to do the heavy lifting.
And this model effectively removes the revenue ceiling per customer.
How does it uncap the ceiling?
Well, in the traditional software model, if a client has, say, 10,000 employees, Microsoft can sell them exactly 10,000 Office 365 licenses.
Right, you can't sell a seat to someone who doesn't exist.
Exactly. Once they achieve full penetration, revenue growth from that specific client is limited to marginal annual price increases, maybe 2 or 3% a year.
Just keeping pace with inflation.
Right. However, in the agentic model, if those 10,000 employees start deploying background agents that consume millions of computational tokens every single hour, Microsoft's revenue scales with the computational intensity of the work being done.
Oh, wow. So it's completely decoupled from human headcount.
Entirely decoupled. As an enterprise becomes more efficient by offloading tasks to AI, Microsoft essentially taxes that efficiency.
That is a brilliant business model. But to support this uncapped consumption model, you need a colossal amount of physical computing power. You cannot run millions of asynchronous AI agents continuously without a staggering amount of infrastructure.
No, you absolutely cannot.
Which brings us to the capital expenditure bill. Capital expenditures hit $31.9 billion for this quarter alone.
To properly frame $31.9 billion, that figure exceeds the total annual revenue of many large multinational corporations.
And Microsoft spent it in just 90 days.
On physical infrastructure, management noted that roughly 2/3 of that expenditure went towards short-lived assets, primarily GPUs and CPUs.
Yeah, Satya Nadella mentioned they added 1 gigawatt of data center capacity this quarter.
A gigawatt. It's a difficult number to even conceptualize.
It really is. For context, a gigawatt is roughly the amount of electricity required to power a mid-sized American city, like San Francisco.
It's mind-blowing.
Microsoft added an entire San Francisco's worth of power consumption to their global data center footprint in 3 months.
And they stated they're on track to double their entire global footprint in just 2 years.
Double it. Where are they even getting the power for all this?
That's the real bottleneck.
Yeah.
But operating at the gigawatt scale fundamentally changes the economics of computing entirely.
In what way?
Well, this is exactly why Microsoft is aggressively designing and deploying their own custom silicon.
Oh, like the new chips they announced.
Yeah, Nadella specifically highlighted the Maya 200 AI accelerators and the Cobalt server CPUs. When you are drawing a gigawatt of power, standard off-the-shelf hardware becomes economically inefficient.
Because it just uses too much electricity.
Right. Every fraction of a percent of power efficiency you can engineer to the chip saves millions of dollars in electricity and cooling costs.
Ah, so making their own chips isn't just about speed, it's about not going bankrupt, paying the electric bill.
Exactly. The Maya 200 offers a 30% improvement in tokens generated per dollar spent compared to older silicon architectures.
That's a massive efficiency gain.
It is. They're deploying these custom chips in massive server farms in places like Iowa and Arizona, running heavy workloads for major data clients like Databricks and Snowflake.
So they're essentially paving the globe with servers to guarantee that when an enterprise customer wants to run a complex agentic workflow, the compute power is available instantly.
They're building the infrastructure required to collect the consumption toll.
Right, you can't charge for tokens if you can't process them. Which leads us to the management guidance, because if $31.9 billion in 1 quarter seems staggering,
The future forecast requires a deep breath.
it really does. Management has laid out a highly aggressive playbook for the immediate future. The foundation is built, the consumption billing model is active, and now we need to evaluate their forward-looking projections.
Let's start with the immediate Q4 revenue outlook.
Okay, so Amy Hood guided total revenue to land between $86.7 billion and $87.8 billion.
Which represents continued growth of 13 to 15%.
And Azure is expected to maintain its blistering 39 to 40% growth pace. So the momentum is clearly not slowing down.
Not at all.
But the data point that truly sent shockwaves through the financial community was the CapEx forecast for calendar year 2026.
Oh, yeah. That was the headline of the day.
Management announced plans to invest roughly $190 billion in capital expenditures for the year.
$190 billion in 12 months.
I have to debate this with you. Spending $190 billion in a single year is the equivalent of buying a major Fortune 500 company, like an American Express or a Disney, in straight cash.
It's an unfathomable amount of money.
But instead of acquiring a diversified business with established cash flows, Microsoft is buying depreciating assets. They're buying servers, cooling systems, concrete, and land.
Right, stuff that eventually becomes obsolete.
Exactly. So are they building an impenetrable moat, a barrier to entry so high that no competitor can possibly match it? Or are we witnessing a mutually assured destruction arms race with Google and Amazon, where the ongoing maintenance and power costs of these massive server farms will eventually eat their margins alive?
That right there, that is the central debate for any investor evaluating Microsoft's current valuation.
Which side of the fence are you on?
To answer it, we really have to look at the specific language Amy Hood used regarding supply and demand dynamics on the call.
What'd she say?
She explicitly stated that even with a $190 billion investment, Microsoft expects to remain constrained, at least through the end of 2026.
Wait, constrained? Meaning they cannot build the data centers fast enough to meet the inbound orders?
Correct. Customer demand for agentic computing is so overwhelming that spending $190 billion is merely the baseline requirement to avoid bottlenecking their clients.
That's insane.
They are currently turning down potential consumption revenue because they simply do not have the server capacity to process all the tokens that enterprise customers want to buy.
So people are knocking on the door with cash, and Microsoft is saying, sorry, we're full.
Basically, yeah. So in this context, the $190 billion is not a speculative, build it and they will come gamble. It is a mad scramble to fulfill a massive backlog of guaranteed orders.
Okay, that changes the risk profile completely. When you have that level of visibility into your customer demand, when you know the purchase orders are already signed, deploying the capital becomes significantly less risky. They aren't hoping the market adopts AI. The market is actively penalizing them for not having enough capacity.
And regarding the moat you mentioned, this level of capital expenditure is the very definition of a structural financial moat.
Because no one else can afford it.
Right. If the minimum entry ticket to compete at the frontier AI infrastructure layer is a $190 billion annual budget, the number of potential competitors drops to perhaps 3 companies globally.
Microsoft, Google, and Amazon. That's it.
Exactly. Startups and mid-tier cloud providers are entirely priced out of the infrastructure layer. The game is over for new entrants.
So if the physical infrastructure moat is secure, we have to look at the software and intellectual property moat.
Which brings us to the updated OpenAI agreement.
Right, the OpenAI deal that Satya detailed during the Q&A portion of the call. Microsoft has been bankrolling OpenAI for years, but the exact mechanics of their partnership have often felt a bit opaque to investors.
Very opaque. It was always a big question mark.
But now we have concrete structural terms.
And the structural brilliance of this updated agreement cannot be overstated.
Tell me about it.
Microsoft has effectively de-risked their reliance on a third-party startup while securing their intellectual property pipeline for the next decade.
Because a lot of people were worried OpenAI might just walk away one day, right?
Exactly. But Nadella outlined that Microsoft secured a frontier model, royalty-free access to all OpenAI intellectual property up to Model 32.
GPT-32. I mean, the industry's barely getting accustomed to the capabilities of GPT-4 and the early iterations of GPT-5.
It's almost comical to think about GPT-32 right now.
It really is. Securing guaranteed rights up to Model 32 means Microsoft has a locked-in pipeline of the most advanced artificial intelligence technology on the planet for the foreseeable future.
Furthermore, they secured a revenue share agreement that extends all the way through 2030.
So it's long-term.
Very long-term. This provides incredible predictability. Microsoft is not simply renting this technology on a month-to-month basis. They have functionally integrated the most valuable AI research laboratory in the world into their core operating system.
And they did it without triggering the regulatory nightmare of an outright acquisition.
That is a critical point.
Right, because if Microsoft attempted to buy OpenAI outright today, the Federal Trade Commission and European regulators would immediately block the acquisition on antitrust grounds.
Oh, it wouldn't even make it past the first round of reviews.
By structuring it as a licensing and revenue share agreement up to Model 32, Microsoft gets all the benefits of owning the technology without painting a massive legal target on their back.
It's regulatory arbitrage at its finest.
It really is. And the specific phrase royalty-free access that Nadella used, I think that is the absolute linchpin of the whole deal.
Why is the royalty-free aspect so vital to the consumption model, in your opinion?
Well, because of how the token economics work. Think about it. As consumption scales up, as those millions of M365 Copilot users start deploying agents that generate billions and billions of tokens every single day.
Right.
Microsoft does not have to pay OpenAI a microtax on every single interaction. If they had to pay a royalty per token, their margins would be brutally squeezed as usage increased.
The more successful they got, the more they'd have to pay.
Exactly. But with royalty-free access, Microsoft gets to keep the margin on all that consumption. It is a masterful piece of corporate structuring.
Microsoft supplies the $190 billion physical compute engine.
OpenAI provides the algorithmic brain.
And Microsoft owns the distribution channel to the enterprise and retains the lion's share of the consumption revenue.
It's brilliant. Okay, so we've dissected the staggering raw data. We've analyzed the mechanics of the transition to agentic consumption models. And we've debated the implications of the $190 billion infrastructure guidance and the OpenAI IP pipeline.
Now we need to synthesize all of this into a definitive stance.
This is where we fulfill the Talk Tickers mandate. We take a firm position on what this telemetry means for you, the retail investor.
So are these earnings a bullish or bearish signal?
I will lead with the verdict on this one. This is a highly aggressively bullish signal.
I share that assessment entirely. I really do.
The broader market has spent the last year just waiting to see if artificial intelligence was merely a feature enhancement or a fundamental platform shift.
And Microsoft has successfully proven they are not just selling AI hype, they're actively and profitably monetizing it at an industrial scale.
That $37 billion in AI annual recurring revenue is the undeniable proof of concept.
They've completely cracked the code on enterprise monetization.
They really have. The transition to the consumption-based pricing model, the seats plus consumption structure we talked about, means their revenue ceiling is effectively uncapped.
Because as enterprises rely more heavily on asynchronous AI agents to perform complex background tasks, they will naturally just consume more tokens.
And Microsoft's revenue will scale automatically alongside this increased computational usage without requiring them to acquire a single new customer.
They are directly monetizing the overall increase in global enterprise productivity. It's incredible.
This basically forces us to reclassify the stock entirely. For anyone holding or considering MSFT for their portfolio, you have to understand that the fundamental nature of the company has evolved.
You're no longer evaluating a traditional software company that just sells Windows and Office licenses on a fixed schedule.
No, you are evaluating an AI utility company.
An AI utility company. I love that framing.
It fits perfectly. Just like a traditional electric company charges a factory for every kilowatt hour of power they pull from the grid to run their machines.
Microsoft is going to charge the modern enterprise for every cognitive token they pull from the Azure grid to run their digital workflows.
Exactly. So while the $190 billion CapEx bill might cause some short-term margin compression.
And it might create volatility among more conservative institutional investors who prefer the predictable margins of legacy software.
Sure, it might spook them a bit. But it represents a physical barrier to entry that secures Microsoft's dominance.
It ensures that when a Fortune 500 company decides they must deploy a fleet of AI agents to remain competitive, Microsoft is the only logical vendor with the capacity, the proprietary silicon, and the integrated security to handle the workload.
Which makes this structural advantage. It makes the stock a foundational portfolio hold.
So if an investor is listening to this right now, and is trying to distill this massive influx of information into a single, memorable takeaway.
What is the core metric that proves Microsoft's thesis is working?
It is the intersection of two specific numbers we analyzed today.
Okay, let's hear them again.
It is the 123% AI ARR growth, coupled with Azure's 40% overall growth.
That specific combination.
Yes. That specific combination proves that the massive demand for AI is not cannibalizing the core cloud business. It is actively accelerating it.
It proved the unprecedented infrastructure investment is yielding direct, measurable financial returns.
123% AI ARR growth and 40% Azure growth. Those are the numbers that define the current state of the tech economy.
Microsoft is experiencing historic growth. They're successfully shifting to a highly lucrative consumption billing model, and they are executing a staggering level of infrastructure investment to build an impenetrable physical and intellectual moat.
The scale of their ambition is currently matched by the precision of their execution.
It's something to behold. Now, before we wrap up, I want to leave you with a final provocative thought, something for you to consider that builds on the mechanics we've discussed today.
Okay, lay it on us.
We spent a lot of time analyzing how Microsoft is transitioning to agentic computing, right? Where autonomous AI agents are executing the asynchronous work of human employees.
Yeah, digital workforce.
So the question is, what happens to Microsoft's traditional, highly profitable M365 revenue when their enterprise customers eventually start laying off the human workers who used to sit in those seats?
Wow. It is the paradox of extreme efficiency.
Right. If an asynchronous AI agent can reliably execute the workflow of 5 junior financial analysts, a corporation no longer needs to purchase 5 M365 licenses.
They just need the one license for the agent, and they pay for the consumption.
Exactly. The ultimate question for the next decade of Microsoft's evolution becomes, will the uncapped AI consumption fees generated by these agents outpace the inevitable loss of the basic human subscription seats?
That's the million-dollar question. Or, well, the billion-dollar question.
Are they building a product so exceptionally capable that it ultimately shrinks their own human user base? It is a fascinating dilemma regarding the future of the modern workforce and Microsoft's long-term revenue equilibrium.
It really is the defining economic question for the next era of enterprise software.
We started this deep dive by comparing Microsoft's strategy to building a massive new infrastructure network while still collecting tolls on the old highway.
The blueprints are drawn, the concrete is being poured to the tune of $190 billion.
And the early traffic data suggests the transition is absolutely working. Now, it is just a matter of watching how fast the enterprise world adopts the new route. Thank you for joining us on this journey through the numbers. Keep researching, keep analyzing the underlying mechanics, and we will see you next time on The Deep Dive.